A house in Croydon just sold for £190,000. 3 years ago, that same house went for over £300,000. The seller, desperate, the buyer, cash investor, and that's just one example of a pattern sweeping across the UK. Not just in London, but the South, the Midlands, even parts of Wales. Homeowners are quietly panicking. The headlines say things are cooling off. But what's actually happening is far more dangerous, because underneath the surface, the housing market is breaking. And if you got a mortgage, or you're hoping to buy, the next few months could change your financial future entirely. So what's driving this? To understand, you have to start with the most obvious pressure, and it's one that almost no one is prepared for. Over the next 18 months, more than 1 million UK households will come off their fixed-rate mortgage deals. Many of them locked in rates of 2 or 3% back when the government was practically handing out free money. But now, remortgage offers are coming in at 5 or even 6%. That might not sound huge until you do the maths. If you borrowed £250,000 at 2%, your payments were about £1,100 per month. Now, that same loan at 6% jumps to over £1,600 per month. That's more than £6,000 per year. Just vanishing. For families already stretched thin by energy bills, grocery inflation, and childcare costs, this isn't just painful, it's life-changing, and many are only just realizing what's about to happen, because the pain doesn't come all at once. It comes in waves. Every month, a new group hits the end of their deal and discovers their finances no longer work. This would be bad enough on its own, but it's not just the homeowners who are under pressure. The landlords are getting hit too. And when they feel the squeeze, it spills directly into the rental market. What happens next is already being felt, but it's going to get worse. For years, foreign investors helped keep the UK housing market, especially in London, afloat. Russian oligarchs, Middle Eastern buyers, Chinese millionaires. They came in with briefcases of cash, buying entire blocks off plan before the concrete even dried. Developers loved them. Local councils turned a blind eye. And for a while, their money propped up property prices in the capital, no matter what the domestic economy was doing. But that wave, it's drying up. Post-Brexit uncertainty, global sanctions, currency fluctuations, and tighter regulations have made UK property less attractive to foreign investors. Add to that new taxes like the additional 2% stamp duty for overseas buyers, and the returns just don't look the same anymore. In fact, in 2023 alone, foreign investment in UK property fell by more than 40%. And it's not just the money leaving, it's the motivation. During the pandemic, governments around the world started cracking down on offshore holdings. Suddenly, parking millions in a Mayfair flat wasn't just expensive, it was risky. And this pullback has left a noticeable hole in the high-end property market. Brand new luxury flats in zones 1 and 2, once sold out before completion, are now sitting empty. Developers are offering huge discounts just to shift inventory. We're talking up to 20% off list price in places like Canary Wharf, Nine Elms, and even parts of Kensington. But when the top end starts to wobble, that instability trickles down, because those luxury units were the anchor. If a developer can't sell a £2 million penthouse, the price they can charge for the one bed below it starts to slip. And as top-end prices soften, so does the entire chain. But the real problem? Many of these new builds were never meant for the average buyer, and now that the foreign cash is gone, they're becoming ghosts. Empty shells in a market that's already oversupplied with the wrong kind of housing. This shift is exposing a brutal truth. The UK didn't build for people, it built for investors. And now that the investors are pulling out, the whole foundation is starting to crack. But it gets worse, because just as foreign cash is disappearing, another group is also heading for the exit, fast. And it's a group that once made up the backbone of the entire housing system. Last year, 19% of landlords sold at least one property, but only 8% bought. That means there's a net loss of housing stock being rented out, and it's accelerating. Now, landlords are not villains, but they're facing a perfect storm that most casual investors were never built for. Higher mortgage rates, stricter regulations, heavier taxes, and a tenant base already stretched to breaking point. Let's say a landlord owns a flat in Croydon with a buy-to-let mortgage of £200,000. Back in 2021, their mortgage payment was about £650 per month. Today, at current rates, it's pushing £1,100 per month. Meanwhile, the market rent for that flat might only be £1,200. So, after tax, insurance, maintenance, and void periods, they're barely breaking even. And now, with Section 21 being abolished, meaning landlords can no longer evict tenants without a legal reason, the risk profile has changed completely. Many smaller landlords, especially the accidental ones who inherited property or kept an old home when they moved, are deciding it's just not worth the stress. They're selling up. But here's the kicker, they're not selling to other landlords. They're selling to first-time buyers, or no one at all. That reduces the number of rental properties available, pushing rents higher. But it also increases the number of homes sitting on the sales market, which pushes house prices lower. So we're in this strange place where rent is going up, but property value is going down. The entire system is out of sync, and the longer that disconnect lasts, the more volatility we're going to see. But perhaps the most dangerous part of this crisis isn't in the numbers, it's in the psychology, because something is changing in the way people think about home ownership itself, and that shift could reshape the market permanently. There was a time when buying a home in Britain wasn't just a financial move, it was a cultural milestone, a rite of passage. Get a job, get a house, build a life. That dream, it's fading. Young people aren't just struggling to buy, many have stopped even trying. According to recent surveys, nearly half of renters under 35 believe they will never own a home. Not because they don't want to, but because they've done the maths. A one-bedroom flat in Hackney can cost £450,000. Even with a 10% deposit, £45,000, your monthly mortgage payments would be over £2,000 per month. That's more than most people earn after tax. And while older generations say, well, we had high rates in the 80s too, they're missing the point. Back then, yes, interest rates were higher, but houses were cheaper. In 1985, the average UK home cost about £40,000. Today, closer to £380,000. So for many, the numbers just don't work anymore. And that's changing how people live. Co-living, moving back in with parents, delaying marriage, delaying kids, even leaving the country entirely. Because if the dream is dead, people look for new ones. And that brings us to perhaps the most telling signal of where this crisis is heading. Because when enough people walk away from the system itself begins to collapse. Let's be blunt. This isn't just a housing crisis, it's a wealth crisis. The UK now has one of the widest gaps between homeowners and renters in Western Europe. Over 60% of homeowners are over 50. Meanwhile, renters under 40 are stuck in a cycle of rising costs and zero equity. This isn't just an economic divide, it's a generational one. The older generation bought when homes were affordable. Now they sit on hundreds of thousands in equity, sometimes millions, often in homes that are too big for them. The younger generation paying £2,000 per month in rent to live in a shoebox. But the problem isn't just emotional, it's structural. Because the housing system depends on new buyers entering the market. That's what keeps demand high and prices stable. But when first-time buyers can't afford to buy, or worse, no longer want to, the base of the pyramid begins to crumble. And when that happens, the people at the top aren't as safe as they think. Because wealth isn't just what you own, it's what someone else is willing to pay for it. And when buyers disappear, prices follow, fast. So where does that leave us? That brings us to the final question, the one everyone's quietly asking but afraid to say out loud. You see, on the surface everything looks calm. The headlines say prices are slipping slightly. Some areas are cooling, others are showing resilience. But that's not the whole truth, because behind the averages, the market is freezing. In some regions, transactions are down by more than 30% year on year. That means people aren't buying, but they're not selling either. It's a standoff. Buyers are waiting for prices to drop further. Sellers are clinging to yesterday's valuations. And in the middle, estate agents struggling to close deals. But the longer this goes on, the more pressure builds. And that's why experts are warning. We're not heading for a crash, we're already in one. It's just moving slowly, a silent correction, and for many that's even more dangerous, because they won't see the fall until they're already in free fall. And every correction creates opportunity. For those who understand the signals, if you're buying, wait for value. If you're selling, understand your position. And if you're renting, keep your costs lean and your eyes open, because what's coming next isn't going to be fair, but it will reward those who pay attention.